Ladies and gentlemen, Tesla had a pretty good day today, definitely better than most of us expected, really outperforming everything. Okay, Tesla was a real leader today through the good times and the bad times of the day, throughout the many different headlines that came out. But we need to talk. Is this the start of a large rally for Tesla? Is this a dead cat bounce for the markets? Meaning, are markets going to bounce from here and then move lower? I think we really need to discuss this because broadly speaking, not including Tesla in this, but broadly speaking, I did not like what we seen from the markets today. Okay, I did not. Because why? Well, you bounced a little bit, you kind of bounced around, but you didn't get a strong recovery. And I think it has to do with the data that came out today and the real recessionary signals that are starting to flash. Now, normally when you're coming out of, a crash event, you can see a large bounce, right? There's some momentum when people get back into the markets. Today, it felt more like a position unwinding event for the bulls more than it really did anything else. And that's kind of alarming. Now, if you also look at the S&P from a technical basis, it does not look good. Okay, and really this had to do with yesterday and the follow through into today. Now, there's some good news here as well. The markets have already fallen about 5%. I do think you bounce further from here. Next week, we're going to have some major events in which I will go over here in this video. But I think top of mind for a lot of people is tariffs. And we are supposed to get the tariffs potentially going back into effect on Canada and Mexico next week. It would not surprise me if there's another delay. And it would not surprise me if the markets rallied off of that, at least temporarily. Bigger issue would be if the tariffs are not delayed, if they do go into effect, because of the implications for a possible slowdown or a larger slowdown in the economy. See, recessions happen for, a couple different reasons, or many reasons, I guess you could say you could have a recession, but they happen specifically because of just a couple of different things. Number one, confidence, okay? If you are seeing people getting laid off, if you are seeing Doge just going out and, firing people, if you are one of the 2 million government employees, I bet your ass you're not buying a new car right now. You're not buying a new house right now. You're not doing any extra shopping right now. That in and of itself is quite negative, right? For consumer spending behaviors. And we actually seen that reflected in the data today. As I shared with you in the previous video, personal spending fell negative 0.2%. Now, some of you guys are going to say, well, December was really strong, so, January came down a little bit. And I guess that's fair, but not really, because a lot of the time, January's a very strong month, in fact, right? Okay. Very rarely do you actually go negative. And that's what just happened. In fact, in 2022, December was positive 0.2% for personal spending. January was positive 1.9%. So it's not always the case that January is a weak month. And almost never do you actually go negative. Even during 2022, we did not have a negative month-over-month print of personal spending. It wasn't until March of 2023 you had a negative print of negative 0.1%, but that was coming off of January and February that were overall pretty strong. This is a big warning sign. And I think part of the issue right now for markets is the Fed is kind of incompetent. I mean, I've had the Fed's back a lot here on this channel. I've defended the Fed. They've been put in a bad situation. They've had to do what they could. But right now, it just seems like the Fed is turning a blind eye to what's clearly weakening in the economy. Far from a recession at this point, but could be going down that path. And I think that's why the markets have started to get this growth scare. because of, not only growth slowing down, but the Fed is not reactive to this. I think it would be a little bit different from the market's perspective if the Fed was cutting rates, if they were, ending quantitative tightening or doing something that is constructive for markets. They're not. Okay, the Fed is turning a blind eye, almost like they just really don't care at all. The real problem with today, and kind of the reason why it makes me a little nervous, is the Atlanta Fed GDP Now tracker. I talked about this in the last video, but this thing plummeted. It was at positive 2.3%. It fell to negative 1.5%. Given that, I don't think the market should have bounced today. I think it should have been a negative day, okay? And that's why, again, I'm kind of nervous for this just being a dead cat bounce, because we're actually seeing that growth scare now materializing in the data. And while there was not much of a downside reaction, it feels like a little bit of a pump to let the hedgies, for lack of a better word, get out of some of their long positions a little bit higher than where we were in the past couple of days. Again, what Elon said today is kind of alarming as well. He actually shared this from Geiger Capital about the GDP print, or new estimate that came in at negative 1.5%. And Elon says a more accurate measure of GDP would exclude government spending. Otherwise, you can scale GDP artificially high by spending money on things that don't make people's lives better. For an example, you could shift everyone who is building cars to working at the DMV. That would result in no cars and a much worse standard of living, but GDP would appear to be the same. And what this kind of screams to me is GDP is probably going to fall further if Doge continues to cut government spending. Now, is that enough to put us into a recession? When I think about that, and I think about businesses that are less willing to invest right now, given the uncertainty of tariffs, that even if you were in China, like Nike or something that is produced a lot in China, if you want to open a factory in the US, it's going to take some time. It's not going to happen overnight. And there is a lag there where, one, tariffs could really eat into margins, number one. But number two, it creates some uncertainty where companies are going to invest, and that capital expenditure potentially slowing down would also be an issue for the economy. Just that dynamic together does not sound good for economic activity, at the very least. And with markets that are currently expecting 2-ish% GDP this year, this is kind of a shot across the bow, if you will. This is a slap in the face to a lot of people. It's not looking as likely now, given the data that we got today. Also, when you look at this from Guy Berger on X that says, the recent deterioration in future headcount plans among American businesses has occurred across all business sizes. Take a look at this. On December 1st, 2024, all categories besides businesses with 250 employees or more were positive. This category here was negative 3 points for 250 or more employees. Take a look at now. Just, 2-ish months later. The 1 to 4 employees category is positive. 5 to 9 employees is slightly negative. 10 to 19 employees is positive. 20 to 49 employees is positive. 50 to 99 employees is really negative, negative 4.1. 100 to 249 employees, the worst, really negative there. And 250 or more employees is also really negative. You've seen what looks like a deterioration across the board for corporate hiring plans. Ugh. Yikes. When I put all of this together, and we know the Fed is really incompetent right now, I think it's really raising the odds of a policy error. And I think that's where you could get an even larger growth scare, because it's one thing to say, hey, the economy's weakening, like this doesn't look good. It's another to say, hey, the economy's weakening, this doesn't look good, and the Fed's not helping us. They don't plan on helping us. That's where I think the larger problem could be for markets. Now, I hate to rain on anyone's parade here because Tesla's finally bouncing, and I do think the bounce can continue. Okay, there's something I shared on X that I think is very important. It's from Seth Golden a couple of hours ago. He says, now that is something you don't see every day, week, or month. NASDAQ 100 5-day RSI is 11. Such a level has only been seen 4 previous times, and 2 such occurrences were during the 2022 bear market. In fact, all occurrences marked lows or created a bounce within 2 trading days. Like, I'm not surprised we're bouncing today. You were so negative, right? I mean, overall sentiment was negative, but like, again, RSI's relative strength index is very negative, okay? But I worry this could be something like, a dead cat bounce, where you could bounce a little bit, and then the reality of the situation comes back to people. And I don't like what we've seen today. Now, this does not mean get out of Tesla, run away from markets. That's not what I'm getting at here. Tesla's down 40-some% from all-time highs. You've already fallen a lot. It makes 0 sense to reduce positioning in Tesla at this point, in my opinion, because I ultimately don't think we're going into a recession. Like, if we go into a recession, that would be terrible. Okay, that would be like the worst possible situation for Tesla and for markets. I think if we continue to get some bad data, the Fed's gonna very quickly change from being worried about their dual mandate to, oh fuck, let's protect the labor market, right? But between now and then, you could see growth concerns come back, and I think that is the issue. And in this market, it is sell first, ask questions later. And like we seen in 2022, if you were investing during that time, we never went into a recession, but the markets fell 27% because everyone believed we were going into a recession, and the Fed was unable to help us. Okay, if the Fed is in a similar situation now and fears about a recession rise, I mean, you're only down 5% from all-time highs. Is that enough? Is that enough, repositioning? It would seem unlikely to me. But again, I'm not surprised that we're bouncing today. Tesla stock specifically, it looks like you bounce off your 200-day moving average. Wouldn't surprise me if the stock gets back to its first level of resistance around that 310 level. In fact, I expect that will happen at some point, probably in this upcoming week. I do think markets could bounce, further from here. And that would obviously have a positive effect to Tesla stock as well. And I really think that the fear in Tesla is far overblown. All I'm saying is you probably don't want to be all in on margin in this market. I don't think this is going to be the typical sell off 3-4%, markets buy it right back up again, because there has been a deterioration. There is a change. There is a growth scare, but not just the scare. Like, it looks like growth is actually slowing down. And that's different than other sell-offs or pullbacks we have had in markets. Now, when I also look at the SPY from a technical perspective, it's not a whole lot to like here, okay? You have not been below your 20-day moving average on the weekly candlestick chart since November of 2023, so over a year ago. You did fall below this on the week of August 5th, but by the end of the week, you were back above it, okay? And every other time, there's 1, 2, 3, 4, 5, 6, 7, 8 different weeks in which you touched this level and bounced. The week of January 17th, you did fall below this, ended up coming higher, okay, into the end of the week, right? You kind of went lower this week, ended up being a positive 3% week. This is the first week that you're actually down about 2% on the SPY, and you're going to close below this 20-day moving average. Now, ultimately, that could set you up for a retest of the 50-day moving average on the weekly candlestick chart, which would be down to about 560. And I think that is a pretty good level to test. I think you'd want to definitely be doing some buying activities around then, more so than today. And by all means, if you want to go out and buy some stocks, like that's not a bad idea, right? Markets are down 4% or so from all-time highs. Like, you know, buy some stocks, right? But I think we do ultimately go lower, okay? And 10% down on the S&P would put you back to about 553. And I could see that as certainly possible. 200-day moving average at about 568 on the daily candlestick chart. Now, once you get down to these levels, you don't have much as far as levels of support, perhaps around 535 or so, and then back to about 520, there'd be a level of support. But it really just depends how the economy evolves from here and how the Fed evolves from here. If the Fed is not trying to accommodate the markets as we get a larger growth scare, that is going to be a problem. Now, coming next week, we are going to have a lot of economic data. Starting off Monday, ISM manufacturing PMIs, a couple Fed speakers, new orders, prices paid, employment, all of that will be important. Tuesday, we're really not going to have much. You do get some data out of Australia. You get the economic optimism index. You're expecting that's going to get a little bit better. So you want to watch these indexes of sentiment and optimism. If they don't get better, then that's another problem. Fed Williams speaks at 2:20 p.m. on Tuesday, and that is it. On Wednesday, you have ISM services PMIs, the Fed Beige Book, and some other smaller data points. Thursday, you're going to get, let's see, the wholesale inventories month over month, imports and exports. So you'll get a new GDP update by March 6th. It looks like you will get a, it says March 3rd on Monday, you'll get a new update. I believe that is going to be because of the manufacturing PMI. So that could change the GDP estimate. But if you get more data that shows that maybe we're in negative GDP territory, that's going to be hard to have a good market during that environment, like damn near impossible. Again, Wednesday, ISM services, that's going to be very important since that is a large chunk of GDP. Services very important for people spending money. Again, Thursday, exports, imports, new GDP update. Fed Waller speaks at 3:30 p.m. Couple bond auctions as well. On Friday, you will get the non-farm payrolls. I'm expecting 133,000. The unemployment rate expected to stay at 4%. Average hourly earnings, participation rate, all of that will be important. You do get a speech from Fed Jerome Powell as well next Friday. Couple speeches from Fed Bowman, Fed Williams, Fed Kugler also. So, heading into next week with important data like this, I'm just not super optimistic that this bounce is going to hold, right? Dead cat bounce could definitely bounce back up to the 590-ish level, 592-ish, and that is potentially where you'll find some resistance. Your 100-day moving average as well, around 592.48 would be a good level to hit, and then see if we get some resistance there. Wouldn't surprise me if we do, and then we come back down lower. But again, as far as Tesla stock, I love what I've seen today. Tesla is down 40% from all-time highs. I do think Tesla's an opportunity here, and especially if you have a long-term time horizon, you want to be buying as much as possible. But you could get a better deal on Tesla if markets do fall further. You could see Tesla around that 250 level. That is a very important level. If things were to get really bad, we're talking like recession. If we actually did materialize into that, as low as the 190s or 180s could be in the card. But, 250, could we see that if we get more market weakness? Yeah, probably. And good news ultimately is once we get this flush out of markets, you probably do see things get better throughout the remainder of this year, as long as we obviously don't go into some kind of recession. So, ladies and gentlemen, let me know what you think about this information down below in the comments section. Have a fantastic rest of your day, and I will see you in the next one.